Good afternoon. My name is Ananya Kumar. I'm a senior fellow at Atlantic Council's Geoeconomics Center. I'm very excited today to have this conversation on the next generation of tokenization and stablecoin policy. And I'm really joined today by two people who are at the bleeding edge of this conversation. We're joined today by Chia, who's the managing director at Monetary Authority of Singapore, and Charles Cascarilla, who is the chief executive officer and co-founder of Paxos. Thank you for joining us today, and let's dive right in. Chad, I want to turn to you first as someone who provides tokenization infrastructure to a wide range of market participants. How have you seen demand evolve for tokenization in particular, especially since the passage of Genius in the US?
Well, there was a building momentum around stablecoins, which are really the main asset that's been tokenized. And that momentum was building for maybe the past year and a half. And then you had a shift in administrations, and there's been a change in receptiveness around stablecoins and tokenization. And that's happened around the regulatory and policy apparatus. And then you had Genius pass. And so you went from just having more regulatory and policy clarity to having legal clarity. And that has really created a fundamental adoption curve and in fact, forced everyone to think, well, what do they want their strategy to be? And that could be firms, of course, that are in the fintech land, but also a lot of traditional banks and brokers, and actually really on a global basis, because the dollar is used on a global basis. And it's created a set of standards that actually are very similar to what Singapore adopted in its consultation papers and what other jurisdictions have adopted. And so I think this is really positive for tokenization moving forward as a source of innovation. And I think it will expand beyond just being about stablecoin, which are conventionally everyone thinks of as dollars, to being other fiat currencies, but also, I think, just as importantly, about other types of assets. Because really the promise of the blockchain is to re-platform the financial system, right, which shouldn't just be about one thing. It should be about almost all assets being able to move instantaneously at the speed of the internet.
Right, I think you've already evoked Singapore's sort of regulatory authority and the masses work on this. Jiun, let me turn to you a little bit about a few projects that you have ongoing, including Project Guardian, which has been ongoing for the last 2 years. You've also talked really clearly about the benefits of tokenization for the larger economy, but specifically for capital markets. I'm interested in thinking about what is the next stage beyond pilot programs, beyond these programs running for 2 years for MAS and other sort of central banks that are leading on innovation?
Sure, Ananya. Thanks very much. Happy to be here with you and Chad. So yes, we've been running experiments and pilots for a very long time. We've done lots of projects around tokenization of different asset classes, around bonds, FX, funds, and so on. I think the private sector participants in these projects have shown that it's worked. They tell us it makes sense in terms of time and cost. It makes sense in terms of their offerings to their clients. Now, has it gotten out of the lab? Absolutely. So it's not just pilots, it's not just experiments. It's made its way into commercial use cases. So out of some of these experiments, a couple of key financial institutions in Singapore partnering with an international financial institution had launched a joint venture company to offer multi-currency settlement on-chain. And also, more generally, more tokenization capabilities. We've also seen lots of offerings by financial institutions to their clients using tokenization, usually in the cash management space, multi-currency cash management and cross-border payments and settlement. So they've done quite a lot of that. And a major international financial institution, as I understand it, has told me that they've recorded over $2 trillion in tokenized transactions to date. So it's there. And there are stable coins issuances. Paxos is one of those that were early in the game, and they've been doing this within the regulated space for quite some time. So it's out there. There are commercial applications, but I would say the variety that is currently out there now is around private networks or small groups of networks coming together. So it'll be a single bank, say, offering it to their clients. So that's their private network, or maybe a very small group of partners coming together to create that network. There are others that are trying to create an open platform kind of network and attracting participants and products onto their platform. But I think what needs to happen for the next stage to truly scale is a little bit like what Chad has mentioned. You got to move into multi-assets onto the chain.
Right.
You got to move good, reliable settlement assets onto the chain. And the way we're thinking about it is that if we go down the path of private networks, we may end up with one or two possibilities. One is that eventually there could be hyperscalers and monopolies, which is probably not very good from a public policy point of view. The other possibility is that you have disparate, isolated subscale networks that are built. They don't talk to each other, and tokens can't move across to each other, and then that fragments liquidity. So neither are good outcomes from a public policy point of view. So what we think are needed are for networks to be able to link up to each other.
Right.
So we've been working through the Guardian initiative, but also a second initiative called, which we call Global Layer 1. Both of these are consortia with financial institutions within the regulated sector and also policymakers, not just ourselves, but with others internationally. And we're creating public goods on this. So firstly, on interoperable networks is a key initiative that we're working on. So it's about setting standards and templates that network builders can put in right from the start so that in future the interoperability is seamless. It can be done when the need arises. The second area, of course, is through Guardian, through the various asset classes, fixed income, funds, and so on, that we work those through, work on taxonomies, data definitions, standards, so that a token to one party means the same thing to another party, so it crosses, right? And so I think that's what we want to move towards, where scale can be achieved through interoperability, and scale can be achieved through standardization. So that's what we hope to move towards.
Right. Maybe I'll turn to you on that. Jiun's talking about maybe two challenges to scalability here. One is a potential fragmentation if things don't go well, and then also potential consideration for monopolies in certain pockets. Do you perceive those challenges to be the same from your vantage point?
You know, it's going to be interesting to see how things develop. If we just talked about the dollar stablecoin market, there are two dominant players today. There are a number of other players behind them. You know, I'm not sure that you would only end up with two.
Right.
I don't know if you'll end up with more than five. I think it'll probably be more than two, you know, at the most five, where you'd have something that would look like the traditional payment sector today, where you have Visa, MasterCard, Amex, and some others. And so that's a rough analogy. It's not a great analogy, but it's a rough one to use. And so I think you'll have these large rails, and then I think there'll be a very long tail. Potentially thousands, just like you have with rewards cards and prepaid debit cards and co-branded cards. And I think the very interesting thing that's happened, partly with Genius, but also because of the work of MAS and others, is you want to have interoperability, which the blockchain enables, and then you also want to have standards, which regulatory and legal frameworks help to set. And if you do that, then it's good to actually have some fragmentation, because it creates a lot of experimentation, the ability to really customize, which is part of the goal here. Is you want to have customizations, you want to have the ability to have experimentation in ways that maybe we hadn't really thought of or didn't know, so that the market can work itself out. But there will inevitably be consolidation again after you kind of have this period of unbundling. And everything is bundling and unbundling in some way or other in almost every industry when you get to points of innovation. And so I don't know that you know, you'll stay in a fragmented state, but with the right standards and with the right interoperability, then I think, you know, those things can work themselves out in a way that will be constructive to the market.
Right. I like the way that you've sort of divided it into sort of technological interoperability, blockchains talking to each other, but also legal and standard interoperability between jurisdictions. Obviously, we're in the rulemaking process of Genius at this point, and a lot of stablecoin providers are asking for clearer rules of the road from other jurisdictions and how reciprocity is going to work across jurisdictions. Do you have a perspective there as well?
Well, I think we're somewhat unique here because we've actually issued from 4 different jurisdictions. The U.S., Singapore, Abu Dhabi, as well as in Europe through the FinFSA. I think one of the interesting things is the standards are all very similar in those jurisdictions. These are all very high quality regulators who understand prudential oversight. And essentially, one of the big questions is, well, what should your reserves be? And basically cash and cash equivalents. That would make sense. Where have we seen problems in the stablecoin market and the crypto markets is where you're kind of pretending that something is a dollar, but it's not really backed by dollar assets. It might be backed by assets that fluctuate in price pretty significantly. And that creates instability because you're trying to pretend that something is always going to be a dollar and it's not. And sadly, we've seen a lot of examples where that's caused problems. But you could set those standards. We didn't need Genius in essence to set that standard, but it helped to codify it in law. The other thing is that you now have to have prudential oversight as an issuer. There's a lot of issuers today. In fact, most issuers don't have prudential oversight. They might be using money transmission licenses, for instance, like Circle, or they might be operating with assets that aren't just dollars, like Tether. They have Bitcoin, gold, and other loans in their portfolio. And so, this sets those standards so that you can have a clear way for everyone to be able to operate and understand what that means. And I think once you start getting out of some of the more sophisticated regulators, the Treasury is going to have to make a designation. That's part of Genius. Well, who really is going to be considered a reciprocal regime? And that's important because the last thing you want is to allow something that doesn't have the right level of oversight into markets and into the general financial and payment system, and could essentially be a source of destabilization. Whereas stablecoins should actually be a source of stability because they're not fractional dollars. And so now you have a capacity to have a payment asset that is not a fractional dollar, and that doesn't mean we're getting rid of the banks. It just means that you can create some way of segmenting some of the risks that naturally build up in the financial system, and where you have accelerator effects that have caused problems in past financial crises. And so no one wants a stablecoin to be a source of that. You actually want it to be, conversely, a source of stability.
Jiun, maybe I'll turn to you with a similar question, which is how do you view these demands for reciprocity across jurisdictions from your vantage point as a regulator?
Yeah, I mean, I understand where that comes from. It's an important issue. A lot of use cases for stablecoins will be about cross-border payments and settlement. So it will be a cross-border use case. So I can certainly understand that this is important to sort out. But at the same time, I think it's important to not underestimate the significance of the first step that has been taken, which is to bring stablecoins from an unregulated space into the regulated space. But we're still at a very initial stage of that. So it's just several jurisdictions that have taken that step. And the fine print is still being worked out on some of these legislative frameworks. The framework is out, but some of the fine print still has to come out. And in other cases, the printer is not even dry yet. So we're still at very early stage, but it's critically important that it's been brought into the regulated space. Now, I think what Chad says is important, that I think for most of the early movers in terms of the adoption of the legislation, I think the fundamental elements of that regulatory regime, broad similarities. I think people have a common understanding of what's needed, but there are still some areas where there are differences and variances. Now, so it probably will have to go through a process where I think we learn from each other what we have put in place, have a discussion about where those differences are and where those differences probably should be narrowed, and what are the better practices. So that process will have to probably happen. Eventually, for reciprocity, you need trust in each other's regime. The regulators need to trust that that regime is equivalent broadly, that the other regulator is able to supervise this well, and so we need that process where that communication happens. Now, that communication happens probably, as I said, we have put in place the national regimes. We have this discussion about differences that should remain, where it should be narrowed, and also confidence around regulatory and supervisory regimes. But also, I think increasingly importantly, which is as the use cases get cross-border, then that reality also will prompt the pace of this cooperation to happen. And so that supervisory cooperation for cross-border regulation supervision of stablecoins will have to follow the commercial use cases when it goes cross-border. So certainly from our point of view, I think we see the importance of that. So I think it's now important for the main regulators to have the same view after they take the step of putting in place national legislation.
Yeah, and of course the problem that they're sort of tackling there is different for different jurisdictions. For a lot of jurisdictions, they're tackling the problem of offshore issuers of non-local currency stablecoins, which is an entirely different sort of financial stability concern than an onshore issuer of a dollar-based stablecoin in the U.S. I'll also say here, maybe just plugging our work a little bit, the Atlantic Council is going to be doing quite a bit of work with the G20 and the upcoming presidency of the G20 on stablecoin standardization, harmonization across G20 member states, at least as a starting point to get standards to the same place. Maybe I'll get to the questions about governance here. Of course, MAS is stated to be this really innovative central bank. The question that central bankers in the U.S. often ask me, and central bankers from around the world, is how do you find the balance between encouraging private innovation and also finding a role for the central bank that is related to innovation and oversight of innovation? So if you have any thoughts there, I'd really...
Yeah, I mean, for us, it's in our DNA, so we understand this quite well. I think in fact, all central banks and regulators have a goal that they want to see stable markets, resilient market infrastructure, and also a strong, robust payment system, right? So I think everybody agrees on that. Now, this is a new space. Technology is bringing in new innovation into this space. And I think all regulators want to see this develop in a sustainable, stable fashion going forward. It's very important that this new technology is harnessed and the innovation is brought in within the regulated space. I think regulators would see it that way. So I think certainly from our point of view, there's no trade-off. We want to foster and support the development of this new technology and innovation within a regulated space. So that means you have to play an enabling role, but you also have to play a regulatory role. You have to safeguard some of the risks that the innovation will bring, but at the same time, you have to put in place some of the conditions for the regulated sector to work and take off. Because remember, we're coming in with an innovation that has first taken off in the unregulated space, and it continues to grow in the unregulated space. So actually, the regulated space has some catch-up to do. So I think an initial phase of this thing, the enabling role probably is quite important, and regulators can and should play a part in terms of legal clarity, regulatory clarity, where things are, and I think there's also a role, and we've tried to do that, and together with other like-minded regulators internationally to have these standard-setting work that we've been doing and the interoperability work that we've been doing. So I think those are all important. I think another equivalent area of work that is quite important is to get to regulatory-grade infrastructure for this to happen. Again, with coming in from the unregulated space, people are working off public blockchains. They're not regulatory grade. I think the initiatives are starting to put in place layers that, approach regulatory grade. But that's another area that regulators should get involved in the discussion and the dialogue to get the infrastructure to the level. So why do we need regulatory grade? We need it for compliance, right? So you want to make sure that AML/CFT compliance is built in, and national rules and regulations. If this is going to be cross-border, then you got to be able to program that in, and the compliance is able to be automated. So those are all important points. Yeah. But maybe just a word, which is I think as this develops and as this scales, and we have products and we have stablecoins that achieve more systemic importance, more cross-border scale, then the protection elements of the regulation will probably have to scale up as well. Right. So I think there's a phasing of this. There's an initial phase where I think we have to help with a stable direction of growth for the sector. And then later on, I think we have to worry more about the financial stability implications, and then there'll be potentially new layers of regulation that may be appropriate at that point in time.
Right. Maybe I'll turn to you on this. Do you think this is a sort of ideal model for how central banks and regulators around the world should be operating? Is there a certain need that they should be filling right now that they're not currently?
Well, I think there's a number of different approaches to this, to making innovation possible. The first is really trying to understand what's happening in the market. So that's just being open to dialogue and meeting, et cetera, something that the MAS has always been very open to. And so that as a chance for the industry to interact and help to come to a mutual understanding of where is the market going.
Right.
And anytime you're starting to create new financial products, there's a question of kind of riskiness and size. So something could be risky, but it could be very small, and something could be less risky, and it could be, getting quite big. When do you cross over to having the right type of regulatory oversight? And having some flexibility in that allows there to be innovation, but at the same time, make sure that as something becomes more and more important, there is the right level of oversight. I certainly think that there's been different approaches to that in the stablecoin market over time, and we've certainly tried to take one tact, which is we're going to go get regulated, we're going to ask for permission, we don't want to ask for forgiveness, and et cetera. And I think that means that we were able to set a standard that, in fact, legislation in the U.S. Actually moved everyone up to. And once we get the rules in place, everyone will be there, and I think that's actually going to be a very good thing. And so it'll be a process of maturing the space. $300 billion of stablecoins is a significant number for sure. On the other hand, it's pretty small within the scale of M2, et cetera. And so, you're probably at that point where this is time to really make sure that we have the right type of oversight. And I think, the market's going to constantly change. Right. And it's never easy for a regulator, which in essence is trying to be a referee to try and keep up with the game. You know what I mean? There's these innovations, there's things that are happening, but being able to be part of that, whether through either some sandbox or some conversations, some way of creating gradual frameworks that come into place, really then puts everyone in a position where you can create this innovation in a way that's moving things forward. Without innovation and without some level of disruption, we end up being stuck.
I really like those two answers. One is the push and pull between allowance and oversight over time, and the other bit about creating rules not just for oversight, but then to create a level playing field for all the players that are there. I'm going to turn to our last question here, which is sort of a look into your crystal ball question that I like to ask. But really think it's the year 2030 and we've reached the stablecoin milestone of 1.5 trillion or 6 trillion, whichever end of that you like to sort of believe in. What are the sort of biggest factors that have led us there? Are they technological? Are they legal? Are they regulatory? What is the thing that will get us there to sort of 1.5 trillion or 6 trillion? So.
Yes, all of them. I don't think you can get to that type of size without legal, without regulatory. I think we have a lot of these things now in place. There's more to be done. And then that is what creates societal-wide adoption. So if you started talking about that level of stablecoins, you really have to have traditional financial institutions adopting it, which we certainly see happening, in a really important and scaled way. They're thinking about it. Everyone wants to have a strategy now. What are you going to do? How are you going to put it into place? Are you just going to use it in order to be able to facilitate the capacity to enable crypto as an asset class? Or are you going to do it as something that completely changes your business model because you're in payments, because you do cross-border, because maybe you're a banking institution? So there's a lot for firms to think about and how they want to experiment with it and how they want to put it into place. And as it becomes more strategic to your business, they tend to think a little bit more about it. But I can't imagine you're at $1.5 to $6 trillion and it's just because it's being used more in crypto. That's not even the case now, but it's still less where it largely is. It's going to be so much more about cross-border. It'll be about wholesale. It'll be about both retail and consumer adoption, but also small business adoption, which is oftentimes where we see it. But you're getting into, at that point, $6 trillion is a meaningful part of M2, at least on dollar M2. And so I think you have to have all of those things come together for it to grow 10x from here, not grow 50% from here.
Understood. Jiun, last word.
Pretty similar points. Enabling and sound regulatory frameworks have been put in place. International regulatory cooperation, interoperable networks that are regulatory grade and compliance ready, and the regulated sector growing faster than the unregulated sector in this space. Use cases, the private sector will have to bring the compelling use cases for their clients and build the scale. I'll end with this. We didn't talk enough about the technology, but the technology has to be low cost, low latency, low carbon, high reliability, high security, high fidelity.
That's quite a bit. That's a long list of things that are going to need to happen by 2030.
And I want
Any
to make
thoughts
one
there?
point,
Yeah.
Yes, is that I think one of the great points here is you couldn't put the U.S. Or global payment system on public blockchains today.
No.
And so there is a lot that needs to be done in order to scale that technology up. It's certainly enough to handle what's going through it now, but there is a lot more development that has to happen. We're not going to the moon here. I don't even. We're certainly not going to Mars.
Right.
But we are going to a new place, and so the technology really does need to develop more to be at regulatory scale, as you were saying.
Right.
I completely agree with that.
That's great. That's a great point to end it. So thank you so much for joining us today, and thank you to our audience for joining us as well. Please join back at 5:15 for a session on fiscal tools to ensure that generative AI augments, not replaces jobs. And with that, thank you. Thanks. That was great.
Thank you.
Thank you so much.
Yes, that was fun.